Hi there, Etoro. It is Monday the 30th of May, and that means it's time to take a look at what moved the markets last week. Before we jump in, Howard Marks published another very interesting memo last week. Howard is the very famous co-founder of Oaktree, and he's been writing these memos for, I think, decades. I encourage you to take a look at his memos. They're always full of information. They're very interesting. And he doesn't try to predict which way the market's going to go, but he talks about history because he's been investing for a very long time and provides a lot of his opinion, but also background. So I just wanted to start with this cartoon, which you might find quite interesting. You can tell it's a very old cartoon by these bunny ears on top of the television and reading the caption below. And the thing that's funny, the thing that this tells us is that many decades ago, the pundits, the news presenters, the media were saying very much the same thing that they are still saying today. The reason he shared this cartoon is because of the statement before it. So the key lies in the fact that investors are capable of interpreting virtually any piece of news either positively or negatively, depending on how it's reported and on their mood. So what we find in bull markets is that bad news can't bring the market down. And most certainly in bear markets, we see that the opposite is true. So there have been quite a few companies that have reported earnings in the past few weeks that have been decent, very good even, and yet their stock prices haven't moved at all, or they've even moved down. All right, let's return to our regular scheduling. So last week, we saw the NSDQ100 and the S&P 500 break the downward trend that they've been setting for the previous 7 weeks. So like I said last week, each of these had been heading lower for 7 consecutive weeks. And last week, each one put in a gain of 5 or 6%. We can also see that the US dollar has declined off of the highs. It had set a 20-year record. And as I previously explained, anything that is priced in dollars or any companies that do business with the US and are outside of the US, they suffer when the dollar becomes more expensive. A strong dollar massively affects stocks, but also a number of other investments. And so a bit of the heat coming out of the dollar is good news for most of us. I also have the CSI 300 up here. And as I said before, this is largely considered the S&P 500 of China. And you can see that the downward trend seems to have been broken. There's been a lot of positive news. There's been a lot of negative news out of China. But I think that the positive news is starting to outweigh the negative news. I'll talk about that in a moment. Now, the headlines at the moment, I think probably the thing dominating the headlines through the tail end of last week and probably through some of this week will be about a bear market rally. Now, what happens quite often is that if there is a very strong bear market with enormous declines over a short period of time, then you will experience a bounce in the stocks, ETFs, indexes, whatever they might be. This is considered a bear market rally if there's a rise in whatever asset prices you're looking at, but then subsequently they return to being a bear market. They continue their decline beyond the point at which they began that rally. Now, of course, no one knows whether we are in a bear market rally or if we have really found the bottom and are starting to climb out of it. We can look at history, but of course, the current situation that we're in is unique. There are aspects of it that are similar to points in the past, but there's nothing that is exactly like the situation that we have today. So just as a little reminder, looking at the NSDQ100 here, the NSDQ100 started selling off in around November of last year. It dropped over 20% by March of this year, and then we did see a bear market rally. We saw that index bounce 16% over a period of roughly 2 weeks, and then the decline continued below the point at which that rally began. So classic bear market rally. Now, many investors will be hopeful that we are entering a long-term recovery from the point that we're at, but as I said, there's no way that we can really know. If we go back in history, there are examples of each situation. So for example, at the drop in March 2020, which I would say is unique through just about all of time, saw an enormous collapse in this index and others. Instead of getting a bear market rally, instead of a rally that was subsequently followed by a further decline, we just saw stocks rally and rally and rally and rally. Now, I'm not sure how many of you invested at this point in time. The market was really worried because the fundamentals of the economy and businesses weren't very good, but the stock market just carried on powering higher. You would have heard terms like V-shaped recovery, W-shaped recovery, K-shaped recovery, those letters corresponding to the shape of the recovery in economies, but also in the stock market. One key difference here from our current situation is that the US Fed and many other central banks around the world started spinning up enormous economic support around these bottoms, whereas we're going into a period of tightening. So if we roll a little bit further back to 2018, This is the bear market that precedes the last one that we had. We can see that the index fell off about 23% in total over about 82 days, so nearly 3 months. And on the way down, there were a number of bounces, small bear market rallies, the last one climbing by about 10%. I'm not going to go through all the examples because there are many, many examples through the past few decades. My point here is that you get all types of price action. So we might have already found the bottom and now we're on our way to recovery. We might be experiencing one of many smaller bear market rallies towards the bottom. And there have been periods in history where bear market rallies have lasted weeks, even months, before the market continued to fall downwards. Nobody has a crystal ball. Nobody's going to be able to tell you what's going to happen. But a fairly safe way to operate in the market is to find stocks that are cheap, high quality businesses, put your money into them, cost average if you can, and wait for the eventual recovery, because there will be one. We had some very interesting data beyond the usual macro data last week. So my filter is quite broad, so there's lots of bits and pieces of information here. Lots of PMI data coming out showing that growth is starting to slow. It hasn't entered negative territory for most areas just yet, but it is definitely trending downwards. One very interesting point is that home sales in the US have slowed significantly. There's been an enormous drop off, and this is because mortgage rates in the US have been increasing. But I would say probably the two most interesting pieces of data last week were the quarter-on-quarter GDP data out of the US. This is the second estimate of Q1 GDP for the US, and expectations were at minus 1.3, but came out even lower than that. I didn't see many headlines about this, which I find incredibly surprising. So it's an estimated number, and we'll get the final number next month for Q1. But still, when the first estimate was released last month, there was quite a large hullabaloo about it. This time, not so much. And the second interesting piece of data is the core PCE price index. So this is inflation data. And this showed a drop in inflation by this measure from the March number. So we're seeing several signals in the macro data that inflation is topping out, and maybe has even topped out and is now on a decline. Last week we also had a number of earnings reports, and one of the most interesting, one of the most watched, was Alibaba's. There were quite a few nice surprises in this earnings report, showing a lot of strength, and this saw Alibaba's share price surge on the day. A number of other Chinese equities also rallied on the back of this, as investors hope that the worst really is behind the Chinese market. Another one of my favorite long-term investments is Canadian Solar. So this is a company that sells off with Chinese equities. It's a company that's headquartered in Canada, but is largely run as a Chinese business. By that I mean the founder is Chinese, a lot of their operations are in China. They even have a subsidiary that's listing on a Chinese stock market at the moment. Canadian Solar's earnings numbers were fantastic. Their forecast was in line. I'm not going to go through the details of this right now, but if you take a look at this company yourself, you'll see a company that is absolutely dirt cheap, an international business that's well positioned to benefit from the boom in solar energy over the coming few decades. I added a little bit to my position last week, and will be slowly increasing this position through the coming year. Another big ticket item we saw in the UK, at least last week, was the Windfall attacks announced by the government. So the Chancellor of the UK has said that UK energy firms will now pay an additional 25% tax for the next 12 months. And so this in part funds additional support for people to pay their energy bills, and tends to focus on those that have the most trouble dealing with the rises in prices. It'll take some time to see which companies are actually impacted by this quite heavily, but a lot of the largest energy companies in the UK are international companies, so because of the structure of those companies, they won't be so impacted by this. So I've spoken about Alibaba already, but some other interesting data points that I wanted to talk to are the Chinese government is now acknowledging the fact that the economy is in trouble and that they need to do something aggressive about it. The problem is that COVID-0 is still in place. There are lockdowns in a number of areas, and so it's creating a lot of confusion. The Chinese government has been pushing out additional support at a rate of every few weeks at the moment, with some new tax relief being announced just last week. I still think it'll be challenging for the country to really get going until the lockdowns are lifted, and we're beginning to see some of that this week, and they've announced that they'll be lifting more through June. So we could see some very strong growth in Chinese GDP through the next few quarters if all of these measures coincide with the country opening up, no longer being locked down. A large part of the market does expect this, and so I don't know where I have that article now, but net inflows by investors, institutions, as well as retailers has been on the increase in recent weeks when it comes to Chinese equities, ETFs, etc. All right, what about this week? Well, it's a holiday in the US today, so the markets will be closed. There's some interesting data coming out tomorrow, so we're seeing a lot of PMI data out around the world tomorrow as well as on Wednesday. And then the UK is closed for holidays on Thursday and Friday for the Queen's Jubilee. On those days, we'll also see some employment and unemployment data out of the US. We are also still in the midst of earnings. There are a few names in here that I'm quite interested in. I hold Salesforce, so I'll be interested to see those numbers. My holding's quite small, but at the current price, I think that they are a bit of a steal. All right, that's it for this week. For those that have a shortened week, because many places outside of the US and the UK have holidays this week too, I hope you enjoy your long weekends, and I will speak to you soon. Goodbye.